Welcome to CAM Radio, an ahead of the curve initiative by Cyril Amarchand Mangaldas, bringing you every Friday the latest in legal and policy. Stay tuned. Enjoy listening.
In this panel, we will try to focus it more on M&A deal transactions as opposed to generally doing business in India. So we will try to add that additional layer and flavor in this panel. And for this purpose, we have a very distinguished and diverse panel with me here, starting from Pratibha. Pratibha is the Group Strategy Officer and Group General Counsel at Everstone Group. Before joining Everstone, she has worked extensively with several foreign law firms in the US and also with Nishit Desai and Goldman Sachs. Pratibha is alumnus of University of Delhi, Oxford and Harvard University. We're very happy to have you here, Pratibha. Welcome. We also have with us Nitin Sood. Nitin is the CFO of PVR INOX Group, and he has been with the PVR Group for more than 17 years and has played a very, very important and fundamental role in its expansion, both inorganically through M&A activities and also raising funds and making PVR what it is today, a huge entertainment giant in the country. Our third panelist is Ashish Kumar. Ashish is the Chief Legal Counsel and Group Company Secretary of Dixon Technologies, one of the most fast growing companies, I would say, in the country. And Ashish has the benefit of working on both joint ventures and greenfield opportunities, plus inorganic M&A opportunities. And that's why I call this panel very diverse, because we have a CFO, we have a GC, and we have someone from the private equity world as well. Without spending more time, I would like to quickly provide an overview. As I mentioned, Mr. Shroff has kind of, laid down most of what we would see as VUCA issues from a global perspective. But I would like to touch upon some of the things that we see from a deal perspective, either when you are evaluating transactions or trying to negotiate transactions, or even when you close transactions. So one, of course, there are several VUCA issues. So I've just tried to pick up a few of them to lay down a background, and then maybe we can have a more in-depth discussion. The first thing that we see, especially today, is in terms of business model evaluation. Mr. Shroff alluded to what's happening in the gaming industry. Today, in M&A deal activity, most targets are not in the traditional mold. Technology is all pervasive. We see new structures, new business models. And it is very difficult from a diligence perspective or evaluation perspective to either assess the regulatory compliance of certain businesses. We have seen this in, say, EdTech. There are, say, coaching institute bills pending in several states, which could overnight change the model of EdTech business as such. We've seen this in online pharmacy, where there are pending bills on regulating online pharmacy. So an acquirer or an investor in these kind of, I wouldn't say high risk business, but I would say innovative business, is always challenged in terms of how to value it, how to ring fence this risk, what is the legacy risk that I'm taking on, and the like. So whether it is gaming or fintech or, most of these new age businesses, this is one VUCA issue in terms of uncertainty of the business model itself that we find. Second item, I think Mr. Shroff touched extensively on SEBI and ED investigations. From a deal-making perspective, what we notice that this is not today limited to certain industries. We see a SEBI investigation or an SFIO investigation or an ED investigation in pretty much across sectors, across industries. And as lawyers and M&A experts, for us to again quantify these liabilities, we are never able to tell our clients, okay, how long will this go on? Can we fix it before? Can we fix it after? How do you ring fence? Is this going to carry forward and affect the rest of your business? So again, this is a huge uncertainty when assessing a particular business. And this may be the new normal today. We have to live with this and, kind of move on with the transaction. We don't see transactions get stalled because of this, but we definitely see transactions get delayed because of such show cause notices that are pending and ED investigations or other FEMA investigations that are going on. A third item that we see, and this is nothing new. We have all lived with this as lawyers and practitioners. Not everything is written down, and what is written down is not what is being practiced. We have seen things written down but interpreted and practiced liberally, or interpreted and practiced more stringently. I think PN3 is a case on point. What is written down is that any beneficial ownership, even one share, if it is indirectly in China, then you need an approval. But what is practiced, and even that practice has undergone several avatars since the time it was introduced. It was less than 25%, then it was less than 10%. Now we're actually back to even less than 10% is an issue in some recent transactions. So again, for us as practitioners or for people who want to do the deal, even a simple question like a foreign law firm partner could ask me, do I need an approval? It's always, depends. Depends who is your AD, what is your antecedent, and stuff like that. So our ability to give clear answers and the ambiguities that some of our legislations throw up is very real in deal making. Another example that comes to mind is, say, cross-border mergers and demergers. So if you look at the way the law has evolved today, cross-border mergers is definitely permitted, both in the Companies Act and the FEMA. The intent is to liberalize, the intent is to encourage. But if you look at the practice, there have been 2 attempts at cross-border demergers and 2 NCLT orders on this subject matter. The same NCLT has given contradictory orders where inbound demerger is permitted, outbound demerger is not permitted, only because there is a question mark as to whether merger includes demerger. Now, again, when we have to structure transactions, if we do anything beyond plain vanilla, for us to give comfort to clients is becoming extremely challenging when we are thinking about new or innovative matters. The next point I would like to also talk about is the entire regime we have in public M&A, especially on both disclosures and consents. So regulatory consents aside, the concept of a corporate consent has undergone a lot of change. More number of transactions, whether it is related party or otherwise, has come within the ambit of shareholder approval or even a majority of minority approval, thereby lending that much more uncertainty on both the deal timeline or whether we will get the consent itself. Secondly, the disclosure regime has also become very, very stringent, even compared to other jurisdictions in public M&A. The latest, missive on market rumors. So there are certain classes of companies where you are supposed to, or you're rather obligated to respond to market rumors. And you have to come out very clearly and either confirm or deny or clarify, which, as we all know, is the death of the deal if you start confirming or denying or clarifying the deal even before it is fully booked and cooked. So this, again, is a huge challenge. We've always had challenges with insider regulations in deal making, but I think we finally settled and things were moving in a certain direction and there was a practice which was fairly settled. Now this market rumor, people don't know what is mainstream media that I have to respond to, what is an impending transaction, what is the definition of an impending transaction. So again, the ambiguities relating to public M&A disclosure norms and even to some extent consent norms are high. Another aspect that we notice, especially when we do cross-border transactions, is that things which can be very simply done in most jurisdictions are always complicated in India. So in India, unless you're doing, say, a slum sale or a share acquisition, anything a little bit different is always complex. So whether it's a public takeover, taking a company private, a capital reduction, which is court-based, or as I said, a merger or a squeeze out where, you completely reach 100% in a particular company. All of this, which could be contractual or quick in other jurisdictions, take a lot of time in India. And we see when India is a small piece of a global transaction, it makes us a very unattractive, in the chart, we are always red. We never move to green quickly in any checklist where India is part of, a global transaction. Similarly, something which is like a lockbox arrangement, which is fairly standard in other jurisdictions. We don't see that many lockbox arrangements in India because it is not possible for us to have clear data to come up with a value right on signing and not adjust it with closing accounts later. Nor is our reps and warranties package so reliable, and purchasers are not just comfortable relying on reps and warranties and the ability to enforce reps and warranties and therefore fix the value right on day one. In fact, there's a recent additional angle to lockbox arrangement because CCI now views lockbox arrangement as a gun jumping issue. If the purchaser already has taken over the economic risk at signing itself, even before the CCI approval is obtained, there is a possibility that you have gun jumped and taken over before CCI. So the complexity just gets, heavier with the involvement of every regulator. In fact, the minute you even require one consent or one regulatory approval for your transaction, be assured that there is added complexity to that transaction. Lastly, I would like to quickly touch upon merger control considerations, though, CCI is one of the most consultative and, cooperative sort of regulator in terms of ability to give us guidance. We do see that there is a lot of change when it comes to merger control in terms of either doing a large deal or even a minority deal could come within the scanner. And a lot of time, what practitioners interpret is not the CCI's view. So there have been several instances where you believe that there is a green channel available for you, and you don't you file a green channel form, only to be told that no, sorry, this is not, your interpretation is not right. Or you believe that this is a minority transaction where you did not have control. But as you know, the definition of control is different for different regulators, and CCI could take a more stringent view. So we're still learning on CCI, and the recent, the pending notification on the deal value threshold is only going to bring in more deals within the CCI threshold, adding the VUCA issues to deal making. So with this background and context, I did have more, but I'm conscious of the time. And with this background, maybe we should quickly jump into the panel discussion. I would request each of the panelists to provide their high-level thoughts on the topic before we go into a Q&A.
So thank you, Akila. And as Mr. Shroff has also touched upon, and it is very pertinent when we look at the M&A, and we all are aware and have dealt with in our lives and in our profession. So if you see, when we're talking of M&A transactions, it comes with a certain amount of course, regulatory complexities. One has to be always mindful of that, the specific risk that might come up in terms of what the regulation might throw up when you have started the deal, when you're going through the process, and when you actually kind of sign off the deal. There is a time lag, and you'll have to deal, if you're a listed entity, as you rightly pointed out, you have to deal with various regulators, various authorities, be it CCI, foreign exchange rules, taxations, and also, of course, SEBI. So all these things will have certain element of uncertainty around it, and one has to be really mindful, and all these can have implications both in terms of your timeline as well as cost implication, and ultimately the deal itself. And also, very interestingly, press note 3 has been brought up, and a lot of it also has certain ambiguity that we touched upon and talked about. So yeah, this is pretty interesting. But of course, as Mr. Shroff also said, that this is the time for India. So we all are happily making and going through various and exploring various deals, and we'll continue to do so, and also grapple with what is in front of us. So yeah.
No, I'd just like to add to what Mr. Shroff said in his session. I think the biggest, I've been part of about 4 M&As that I've done for my company, 2 in the listed space, 2 in the unlisted space over the last decade or so. And I think the biggest shift that you see in how the regulatory regime has evolved. Earlier, I would say a decade ago, you could, while there was regulation in play, you could take a call and say, we can get this done and we'll convince the regulator that this was the right thing. I think we are at the other end of the spectrum where you have to, cross every single, T before you take a call to, do it. We are obviously reliant on a lot of experts like you who guide us in the process. But I think crossing the T's has become extremely important. The business logic, obviously, to do an M&A continues to remain, the prime reason of wanting to do it. But if you've not thought through all the regulatory hurdles that you will go through, and almost all the regulators that you mentioned, right from SEBI, stock exchanges, to, if your industry is regulated, which requires permission, and the competition regulator have all evolved. And I've had an experience of dealing with these regulators, in the journey that I've had. And you can clearly tell the difference of how the thinking has evolved amongst the regulators. So you have to be really, really sure as you structure some of these M&As, bring them to logical conclusion and not lose sight of the fact that, if you get stuck in the maze of regulations, the whole rationale for doing a deal, falls through. Because if you can't achieve what you set out to do in a time frame that you set out to do, sometimes the commercial considerations fall apart. So I think for organizations, it's becoming increasingly imperative to manage all of this complexity and still manage to do a deal within the relevant time frame.
I think what's different for our industries in private equity, unlike strategic, we have to take relatively mid-term calls. The whole business is premised on you being able to exit in 7 to 10 years. So anything that can affect your ability to exit can't be done or shouldn't be done. So as in-house counsels, our job is to ensure when we are looking at regulatory uncertainty, which is of course always there in India, and if it's not there at the time, it can come in between. It's assessing what is there, what can come, and is that going to be an impediment to exit or not? So what we look for from our legal counsel is advising us on that aspect. Is this something that we can pay a fine, move on? Is it something that's going to kill the business? You can have the long-term fight, but in the short-term fight, if it kills valuations, we are not going to be able to provide returns to our investors. Or is it something that, we can work with you guys and navigate through restructuring, which as the industry, in Press Note 3, we had to do in many cases because otherwise private equity could not do business at all in India. I think being able to take that call is easy when you know about the regulatory risk when you're doing the deal. For example, Press Note 3, by the time we knew it, now in every deal, even though there's regulatory uncertainty on the threshold, is it 10% less, more, you can navigate it through with your counsel. The problem happens, for example, online pharma, right, or pharma industry as a whole. There's always that threat looming on your head that they're going to regulate price for either your product or all, like the current case. So in that scenario, and pharma is a sector that our private equity fund really focuses on, how do you even do deals in India? And so you live with that regulatory risk that you don't factor into your valuations. And that is the biggest worry for the legal team in-house, that how do you even factor that in? Because it's a deal, no deal scenario for the sector as a whole. Gaming, we can't even touch right now. We can't even think about it similarly. What's even worse is when you get complete surprises For example, on FPI changes that SEBI came out with recently for public holdings, they asked you to provide beneficial ownership, even for a broad-based fund like us. We went and tried and do the exercise, and we just can't. We can't provide beneficial ownership all the way through because we have broad-based investors and they have confidentiality obligations. And we've had back and forth with SEBI, but they've said you're 1% of the investment in the country in the public space right now, so we don't care. Now, that attitude can really kill business because now we have to sell down that holding to be compliant, and we are always compliant. Unlike, I'm not saying strategics are not always compliant, but they can afford not to be compliant. We can't not afford to be compliant because we give reps to that effect. So I think and you're seeing the slowdown in the private equity sector. Despite India shining, despite all of that, we are just not seeing that convert in our sector. And I think it's because of this reason, the added, complexity of regulations over decades is finally catching up. I think the Canadians was the last straw. We've actually, I heard from the market that one of them's completely winding down business in India. And when those stories go back, already we don't see US investors coming in. I think from the last round itself, you'll hardly see any US LPs coming in the Indian market. They might come through the large GPs, but they don't come in directly into the market or through Indian GPs. And now if the Canadians, who I think in total were like over $40 billion, that gets affected, you're really going to see a strong impact on private equity. And I think, you have next to panels on solutions. We really need to figure out how to work with the regulators to explain this. One of the suggestions we had made was it's really the Ministry of Finance, DEA, who has the responsibility to ensure investments in India, and we have a positive environment for that. So all these regulations should really go through somebody who's looking at, what's the long-term effect, because everybody's looking at legacies in the regulatory space for them to leave, but they don't understand their legacy is like killing business. I'll stop at that.
I have a question for you, Pratibha, on maybe you can take a 5-10 year view. How have you seen the conversation in your investment committees change from then to now? Some of the issues were always known that India is complicated, but it's also a great opportunity. How are ICs reacting to this?
So our ICs are actually comparatively easier because they're all Indians, who've settled outside India, very in touch with India, and then our India teams are sitting also in the IC or briefing the IC. So they are very aware of the risk, and they're very aware of the problems have remained either same or gotten worse. The tougher conversation is happening in terms of returns, which again, in turn, are linked somewhere to the regulatory risk. So a lot of deals are getting killed because we have not seen the returns, especially FX adjusted. Yes. So that's the tough conversation. And I see so many deals we look at and then get killed. So that's cost of doing business has gone up, because the number of deals getting rejected after diligencing and everything are higher in the ICs. So that's one trend. But the bigger worry that I'm hearing is from the fundraising team hearing that, what you were saying, that India, you can't rely on anything, and much worse language when we go to the US that I wouldn't want to use here. That's the bigger worry.
So that's interesting.
Things you expect from your outside counsel is also to look around corners and tell you, what do you think is coming, which would affect either returns or doing business or something.
Yeah. For example, Reba.
Everybody do this evaluation, regulatory risk versus return. Any business will do that. Why the private equity investors only?
I think the subtle distinction that I noticed in the three overviews is that everybody is prepared to take risks which are known when you are at the time of investing. these kind of retrospective changes of already done investments. Unknown unknowns is what really changes the game for India. And that is where I think the foreign investors' appetite is different from, say, a domestic investors we know that we will navigate, but they are not prepared to navigate, and their means of navigation are also limited. So I think there's a slight distinction, and maybe I think I read someplace, I don't know, Mr. Shroff, what you think of that bilateral investment treaties are going to come back for investor protection. Maybe that could be an answer for like your FPI issue
BIPA would
or
be helpful.
something like that.
But fighting BIPA, we've seen.
The answer to your question is that I think what's the difference between a private equity investor and another investor? The time horizon.
Yeah.
They want to exit in 5-7 years. Yeah. So their sensitivity to this is much higher. Strategic investor 20-30 years.
5 to 7 years.
No, but a strategic investor will wait for 10, 15, 20 years.
So their appetite is less.
So, you will have,
a lot of people are not coming in just because of the political risk.
So that is very interesting.
What is working in our favor is that there are not too many options in the world.
Yeah.
Right. You're right. No, segueing from there, I would ask Nitin to kind of provide further insight on large-scale transactions. So we see a lot of large-scale consolidation or merger of equals, finding it more difficult. The larger the transaction, the more regulatory issue. And you have just concluded a very large transaction successfully. What did you see, or what is the policy change that you will require based on your experience? Was it, of course, I'm sure it was challenging in its own way, but can we do things differently from a policy perspective, in your view?
Yeah, so my own experience, we've just recently concluded a transaction. It's now, almost a year since we've managed to conclude the transaction and been doing the post-merger integration. I think any listed company merger is quite complicated from a regulatory perspective. You have to cross the T's. Like Mr. Shroff said, I think it's a given that any transaction between two listed companies in India will definitely get scrutinized by almost all the regulators from the time you started doing the conversation, and you really don't know when this will end. So I think companies have to be prepared when they conceptualize, think about this. How do we, ensure that who talk to whom? How do we ensure that our structured digital database is updated? How do we ensure, when the regulator comes back and wants to know every single email, you've handled it well. Also, how have you managed to avoid a leak? In a listed company merger, I think the biggest issue is not just insider trading, but given, as you remain, go towards the fag end of conclusion of the deals with the number of parties getting involved from both sides, the lawyers, bankers, merchant bankers, valuation guys, experts guys, how do you ensure that you can still manage to avoid a leak? I think we got lucky in this case because the transaction timeline was quite tight, and I think from the beginning of the negotiation to end of the negotiation, we managed to conclude it in 20 days. And because the timelines were quite short, I think we managed to avoid a leak. If I think the transactions are elongated, I think it's a given that at some end, the news will leak out. So that is one part of the merger. I think the second big challenge in our case, and that's where we spent most of the time, even before, commercial negotiations could play out, or, you could get two companies who were competing against each other for the longest period in their journey to come together, get both the promoters to think of the big picture of how the landscape will evolve.
Pun unintended, big picture.
Yeah, big picture. Yeah. And, COVID had a big role to play in some of this because a lot of businesses were impacted, devastated. We were running a business which was completely shut for about 12-18 months, zero revenues. And, that and the media landscape was changing with the advent of OTTs. People realized scale was becoming critical. That was the thought process. But I think for us, the biggest thing which we spent time on debating before we even conceptualized the deal was ambiguity around the competition regulation. And this was talk of the media for till the time we finally, concluded the merger, thinking about, whether we are on the right side of the law, are we reading the law right or not? Do we qualify under the de minimis limits? And businesses were shut. Luckily, business, we had a large
Right
revenue
time to do the
pre-COVID.
deal. Yeah.
And but we spend a lot of time debating the same with lawyers. How will this get interpreted? And virtually with negligible revenues, we would not meet those thresholds, and the transaction would not need to be notified. But we also debated what in case if this was there and the interpretation was taken differently by a regulator. What would it mean for a timeline? What would be the impact on the transaction? And I've handled one more transaction earlier where we had to go to a competition regulator. It was required to be notified, and we spent 1 year at the commission, and then we had to give remedies, the whole industry, the definition of the market. What is a relevant market was defined by competition regulator in that judgment. And we debated whether that definition still applies to us in the current context. How media as a landscape has changed. Will the regulator be, looking and referring to the previous judgment? If this was to come, which was given about 7-8 years ago, is the definition of market the same, or has that changed? And what would it take? And in some sense, we took while I think we took a consensus view of the lawyers on reading the interpretation. I think we got confidence from the fact that, in one of the previous transactions that I was mentioning, we had faced a similar situation where the regulation had said that if you are required to notify a transaction if you're buying a division or undertaking. In that case, the turnover of the undertaking enterprise would be taken into consideration. And I remember going to the regulators at that point of time, pleading our case that we are buying a very small division of a large enterprise. And, I think there is something wrong in the regulations, the way they've been written. And they clearly empathized with our case, and they said, but we have to read the regulation the way it is written. And I think that gave us some confidence when we were doing this to, conceptualize and structure it. So that was one large element, from a policy perspective, which was key for us to put this together. There are a lot of other challenges as well, which are typically there in any merger. We announced a transaction on 27th of March 2022. We managed to complete it in 9 months and 14 days, which was one of the fastest amongst two public companies. We had almost in a combined entity 74% public shareholding, which means how the institutional advisors looked at the merger, the resolutions that we were putting together, related party transactions, getting proxy advisory firms on board. All of those challenges, become extremely, extremely important as you're conceptualizing and thinking this through. We were in two different jurisdictions, states. Timelines become extremely important. What if, the business change? How will, the context change? You're discussing valuations between two public companies. If the business changes, or if one of the companies ends up doing better, all of those concerns you have to ring fence. So luckily we managed to cross all the T's. In our case, I wouldn't say, there were too much regulatory risk, because as a sector, we were 100% FDI was permitted, unlike insurance, retail, some of the other sectors where there were more complications. Competition regulation, I think, still continues to remain a very important part. And I think post this transaction, they've also changed the regulation where they've brought in additional deal value threshold. So if that used to exist at that point of time, this transaction wouldn't have happened.
You were instrumental in changing the law.
I wouldn't want to say that. I have a slightly different question on the broader VUCA theme. Because one of the aspects of VUCA is that a new variety of competitor comes at me. You're in the physical movie business.
Yes.
How did you all deal with OTT?
No, I think that was the driver of doing the merger, because as you know, it's very difficult to get two people who've competed against each other to come together.
That's different. I think almost similar businesses, but one of the biggest competitors, people sitting at home and
and that's the next leg of our journey, because one, we had to consolidate in any business today.
Great movie theater, but I go there to eat.
So, but they faced this when television came as well, right? As in, when television came, people said people may not come to the movie hall. So,
Yeah, I think any business has to constantly evolve and adapt to how the world is changing.
That's how we first met.
Yeah.
That's true.
We used to go to movies together to eat.
And
She landed from America.
okay.
but I think what is important is scale is becoming increasingly important. If you don't have scale, your share of voice does not exist. Whether you have to go to the regulator, whether you have to influence the customer, supplier, scale is becoming increasingly relevant. That's happening with a lot of media mergers that are playing out in the current space, largely because you want to consolidate and be able to control a large share of the market to be able to have any meaningful view. This is one part of our journey, which is consolidating the out-of-home entertainment space. But I think the brand has become quite big. So our next leg of journey will be how do we, leverage the brand from here to go into more entertainment spaces.
That's very interesting. I particularly found your insight on how relevant market definition can change from deal to deal with the same, set of industry players. Yes. So, that much more complexity.
I have a question here. We deal with IID on a very big basis. A lot of times, how they have put down the regulations. They say that we come from a very historical background. They give us a story that this particular regulation has been written or drafted this way, keeping in mind that story. And whenever you give an alternate interpretation to that, they will tell you the same story and shut it down. So how do you deal with that kind of regulator or a person who's telling you that we have decided we are sitting with a predetermined notion of this particular transaction or this regulation, and the interpretation will lie like this way, while it may be one to interpret in a different way. So how do you say that? How do you convince the regulator in that sense? That the alternate interpretation.
I think the culture of, contesting or getting adversarial with the regulator or even suing the regulator to that extent is very limited in the Indian context. Yeah, there is no upside to that. So only persuasion is what really works. And, we have brought about change in regulations through persuasion and lobbying.
Much more listening. Yeah, when you compare them with some of the others, IID ke saath mein have a conversation. Yes. Especially with the new channel. So I think it will be okay. You just have to keep at it. Lage raho.
But he's right. The problem is, Dubai, because we say, okay, if there's just one person who did something wrong, you deal with that, prosecute them, but then that gets overruled at SAT, then, there is Supreme Court. They say the person will never get justice.
IRD and RBI are different. There is no RAT or IRD Act or whatever. SAT is different.
Yeah,
SEBI kuch bhi karte, you go to SAT and 90%
so
of
they
the
have
time
a justification, ITA doesn't.
Yeah. And ITA's basic philosophy is how to preserve risk, how to protect against risk. No, IRD a bit more because the very nature of the insurance industry is all about risk. So they are more conservative than the others. But there is, I think, currently we are lucky that we have a person. The chief executive is a listening kind.
Where? But we have been fighting for them to let them invest in AIFs forever. They're not listening.
No, I'm saying comparative.
They will come to you
No,
now.
absolutely. No, but seriously, Panda is excellent because he was here in charge of DFS. He's seen the whole industry, understands insurance. Very different from some of the other regulations.
Okay.
But there is no other answer than persuasion and making your case again and again.
Yeah.
Moving on to a slightly different topic on coming to you, Ashish. So you, as I said, have had a dab at both greenfield expansion plus brownfield expansion. So today, as given your experience, which do you find is easier for opening new markets or entering new products or generally scaling up? Do you think from a regulatory regime perspective, one is better than the other, or you feel that it is all the same?
So, Akila, as one is aware, many transactions, we all have to grapple with a certain level of uncertainties, be it with the regulatory framework, and also, both are driven. What is the specific strategic need of the organization? Now, I'll come to later to what has worked for us and continue to. So, luckily for us, both has worked. But if you ask personally, when you deal with greenfield project, of course, you need to make initial investment. You need to deal with uncertainty in terms of market, because market is uncertain, whereas in M&A transaction, there is a ready-made market in place. Also, there is a fixed set of numbers that you see, because you are acquiring a company where you are aware of what is the numbers. But when you talk of greenfields, what one feels that you are more in control at the outset itself. You kind of dealing, setting up this whole thing from scratch. Now, as a strategy, now what works for you if you're setting up a greenfield project, and if you are like for us, we are a purely electronic manufacturing company. So what we do as a strategy is, if you have got an anchor customer, and when you're setting up your plant or something from scratch, so you have that level of confidence that you are driving on the driver's seat. Also, you are not dealing with uncertainty, because of course there is a process of set of approvals that you need to obtain while you go to the last leg. But at the same time, you have absolute control in terms of the compliances that you have to cater to. Also, the way you want to set it up, the way you want to run, and of course scale it up. Initial investment is there, challenges are there, but long run, I would say, if you into greenfield, personally, I would say the preference would be towards greenfield. Regarding M&A, I think we have talked enough and we know what it is. So personally, I would always favor greenfield.
I think having one party less to contend with as a counterparty is definitely an upside in terms of expansion. Pratibha, coming to you, I think, we kind of, after Mr. Shroff's initial remarks, concluded that India is difficult, but there's no escaping India, and we are here and it is a place to grow. But in your opening remarks, you kind of alluded to things are pretty difficult and gloomy from a private equity perspective. If you had to, come up with, say, one or two wish list in policy, what would you suggest?
Already in place. Let me address your first thing, right? I was talking to the US ambassador. This is Chetam rules. So, the same comment came up and he's like, that's a joke. Honestly, as far as trade is concerned, India is nowhere near an important trade partner for the US. From a pure economic perspective, India does well, doesn't do well, does trade with US, doesn't do trade with US, doesn't matter to our economy at all. So and that's actually visible because that's how their investors think. And they're getting better returns at home with just treasuries. Why will they come out? Maybe not long term, but at least right now they are. And honestly, we've seen they can print money anytime. They're the world's bank. So this whole perception that we have, I personally don't know how far it is true. Indian demographics are great. India can be both a consumer, a producer. Our ability to drive future growth for the world is definitely there. But till we solve this, we won't achieve it. And now investors have figured out that to be true.
So how do you suggest
So how do we solve for it? These retrospective, every country, every developing country has prospective changes. Even though we put a policy, no retrospective changes, we've discussed 2 or 3 already that they've recently announced. So they really need, somebody in the government needs to take responsibility and say this has to be implemented, both with the courts. This whole electoral bond thing is the courts. Now what do you do? Can't just blame the policymakers.
Start with the president. Get a Supreme Court opinion.
Change our constitution.
Exactly. There was this time period in between where arbitration agreements, if not stamped, could not be admissible.
Yeah.
I mean, we were all sitting and wondering, what are we to do now?
Right.
So that retrospective aspect of it really has to stop. Prospective, people still understand. Then you decide to do deal, not do deal, or deal with it at that time. Second, we've already told ministry this. The ministers need to take not just the domestic, the CII takes the domestic promoters with them when the ministers travel, but our industry folks need to travel and they need to have very honest discussions. We can put them in front of the investors and have very honest discussion on what's wrong, at what needs to be fixed. Third, I personally feel FIPB being abolished was a big mistake. Very big mistake, because now the approvals... Yeah, and so they need to create an interministerial body which looks at all these changes and where DA chairs it, and that DA person should be like how they're putting in these new people from the industry as joint secretaries and secretaries, needs to be somebody from the industry. We have
very opaque and not transparent.
Yeah, so I'll give you a very good example. SEBI created SFA. I'm part of the SFA, which is supposed to implement some of the rules that SEBI is coming up with. They said, you don't like our rules, you create. Wonderful. Mr. S. Raman, SIDBI chairman, is the chair for the SFA. He is so investor friendly, he's so industry friendly that it's actually making us help get our view to SEBI because he's the one who's putting it to them. So we need a person like that then at a national level for all regulatory changes that affect
I think
us.
we see a lot of consultation papers, but nobody knows what happens to the comments we give.
So the latest one,
Yeah.
they said SFA will make the rules, but right now the industry isn't pushing on the latest consultation paper. But something needs to be done. Otherwise, I'm telling you, you're absolutely right. You're absolutely right. The future of India can be very, very bright, but to convert it, this panel, what we are talking about, is very, very important to fix.
No, I think that's very helpful. And unless, sir, you have any further questions, anybody in the audience?
Hi everyone. I'll quickly introduce myself. I'm Sanya, head legal at Clove Dental. I have a very nuanced question actually, so I'll quickly take a minute to set the background. So I recently came across this fact that, of course, we have Indian GAAP right now for all of our Indian companies, but it's just a matter of time that it gets replaced with Ind AS. And especially for all the new age companies which are IPO bound, or so they would like to believe, Ind AS is really important, right? Because right before the IPO, you have to make all your financial statements for the last 3 years as per the Ind AS, right? Now, what I learned recently, not too happy about the learning, but what I learned recently is that the Ind AS and of course the IFRS mentions certain criteria basis which you classify your instruments either as a liability or as an equity instrument. And I was really sad to know that some of the clauses that we put in our shareholders agreement, they are also determinant of which direction your securities are going. So there are certain clauses, just to give you an example, like buyback obligations. If it's a concrete obligation on the company to give a buyback to an investor, that is more attributive of a debt instrument. And even if you have the instrument in the form of a CCPS, you end up basically categorizing it as a liability. Now, and you have to value it every year, right? So what happens is that when you are making your accounts before IPO as per Ind AS, there's a lot of liability showing on your accounts, on your financial statements. So the conundrum that I was dealing with, and I thought it would be good to hear it from the panelist over here, is that how do you solve for it? Do you, at the time when you are drafting your shareholders agreement, do you keep this in mind and draft it accordingly? Because that would then mean curtailing a lot of the rights which our private equity investors want. They're already struggling with a lot of issues like assured returns and all of those, right? So first is that, or do you let it be? Because again, it's an artificial liability, right? So is it easily explainable to the merchant bankers at that point in time, or in the roadshows to the FIIs and other investors, that, just live with it, this is just a normal liability. Anyway, we're going to convert all the convertibles before the IPO, or the midway, that you start with whatever the private equity investors want in the realm of applicable law, but change it maybe 2-3 years before the IPO, because the financials are to be made for the last 3 years. So I think I would love to hear it from absolutely Nitin, because he's a finance specialist, and definitely from Pratibha, because she represents private equity investors. How do you balance it? What is the perception, and what is the common practice that people right now are following with respect to this entire sphere?
Take it up. See, my perspective is commercial considerations drive a contract. I think accounting obligations are, come later. So if an organization which is going on to raise private equity, the private equity investor would negotiate terms which safeguard them and which give them a guaranteed return or whatever, a buyback obligation if you don't take them public after a certain period of time. So I don't think when you're doing a contract, an accounting construct would really determine what your contract should read. But if you're in the process of taking the company public, my guess is, I think, and the private equity investor is there with you when you file a DRHP, some of that discussion would also need to be had with a private equity investor, because he's equally mindful of the fact of what would it take to, take the company public, and his exit is likely to happen once the stock is publicly traded. So some of those obligations would fall away, at that point of time. So I don't think when you're conceptualizing or raising capital at the mid or early stage of your journey, you have too much leeway. But when you are ready to go public and when you've reached that stage, maybe that's the time to have a conversation with your private equity investors on some of these issues to deal with it in a more practical manner.
So I don't know if I should say this, but give your private equity investor whatever they want. Except for downside protection, I think that's where the startups get killed. And then, like he said, when the listing happens, you'll have to renegotiate because that's the law. When they're doing the exits, you'll have to renegotiate because that's the law. They ask for assured returns, give it, it's unenforceable. So I'm kind of giving away the mantra. Hope you don't spread it. It will harm us. But I have investors too, and that's the logic I tell my team. They're giving you the money. In our case, we say, give them whatever they want. We'll deal with it. More compliances, we'll deal with it. Having said that, I keep telling my commercial folks and tax folks, or to tell my commercial folks to keep my tax people in check, because they give you too many optionalities. And the promoter will give it to you when you're investing because of the same reason. You're giving the money, but you'll never use it. It complicates the document. It creates regulatory uncertainty. So I don't like CCDs, CCPS, OCDs, OCRPS. Take equity. What I say is, listen, what gives me 100% guarantee I will get my return at exit and not get into a regulatory uncertainty where the promoter goes to RBI and says, this is not enforceable. So I recently spent an hour with the counsel, my own counsel, arguing that don't make me take OCDs in a transaction, because today the law allows it, tomorrow it might not. Same thing. So wherever possible, I, as a private equity investor, have told my firm, give me equity, pure equity.
So basically, keep it simple and give the private equity whatever it wants.
Rather, if you're investing for the risk, so please do risk capital. Don't ask for any return.
Okay, we have two contra views here. Any other questions? Yeah. Thank you so much. Thank you, Nitin, Pratibha, Ashish.